Wall Street, home to the world's two largest stock exchanges, this iconic Manhattan address has come to symbolize corporate America and, in particular, the global financial services industry. There's a famous scene in Martin Scorsese's film The Wolf of Wall Street in which senior broker Mark Hebner explains to new recruit Jordan Belfort how stockbroking works over a lunch of martini and cocaine. The name of the game, Hebner says, is to move the money from your client's pocket into your pocket. Number one rule of Wall Street: I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if a stock is going to go up, down, sideways or in circles, least of all stockbrokers. It's all a fugazi, it's a fake. Clients, Hebner goes on, are addicted to trading, and the challenge for the broker is to keep coming up with brilliant ideas to keep them trading again and again. The client thinks he's getting rich, but in fact it's the broker who's taking home the cold hard cash. Now, that description of how Wall Street works is of course designed to shock. It's out of a Hollywood movie. But in this film we're going to discover how Hebner's description is in fact frighteningly close to reality. We're going to find out how, for many people, trading really is an addiction. How the fund industry continues to mislead the majority of investors into thinking that if only they can find the right stock, the right sector or the right fund manager, they can consistently beat the market. Over the past 60 years and more, a vast amount of time, effort and brain power has been expended on studying how people should invest for the future. With the help of investment author Mark Hebner, I'm going to present you with the findings and explain how education can replace speculation. You're going to learn how to build your own financial security rather than someone else's. You're going to learn how to invest and relax. The biggest reasons why investors fail to achieve their goals is that they aren't in fact investors at all. They're speculators, some you might call gamblers. Of course, the industry puts a more positive gloss on what most investors do. The term it prefers to use is active investing.
Active investing has to do with an investment strategy where an individual or a fund manager is trying to beat a market. I say a market because there are many different markets in this world, international, US, even bond markets. They try to engage in different strategies such as picking stocks, trying to time the market, trying to select managers who will do one of those things and beat the market, and lastly, trying to choose an investment style that they think will have the best return at some near-term future. In essence, it's speculation versus investing. And it's actually a very bad idea because we have mountains of evidence that says that none of those things actually work.
The opposite of active investing is passive investing. Passive investors don't try to pick stocks, times, managers or styles. Instead, they buy and hold globally diversified portfolios of passively managed funds. A passive fund or index fund can be defined as a mutual or exchange-traded fund with specific rules of construction that are adhered to regardless of market conditions. Equity index funds would include stocks of companies in particular geographical locations, for example the US, Europe or Far East Asia. Additional indexes within these markets include segments such as small value or large growth stocks. Securities are purchased and held within a fund when they meet that fund's specific parameters and sold when they move outside those parameters. Think of an index fund then as a rules-based investment vehicle. One of the advantages of passive investing when it's done properly is that it takes human emotions out of the equation. Emotions can have a very detrimental impact on investment returns.
Gambling generally has to do with a situation where there's a 50-50 bet of an outcome. It has to be close to an equal wager or you wouldn't get two sides to the gamble. Those offering the bet, those taking the bet. The analogy for the stock market is we have fair prices which are achieved by millions of traders in publicly traded markets around the world. And those fair prices actually set up a scenario where it's an equal 50-50 bet as to what's going to happen in the very short term. This creates an action opportunity, which is the addictive component as described by Gamblers Anonymous. Now, Barclays actually did a study on this, and they determined over a 10-year period, those who let their emotions drive their investment decisions cost them about 20% of the possible return they could have earned over that 10-year period.
Experts in behavioural finance have identified a number of behavioural biases to which active investors are prone. One of the most common is overconfidence, expecting better returns than you're likely to achieve. Another is hindsight bias, thinking that past events were predictable when in fact at the time they weren't. And then there's regret avoidance, vowing never to repeat the same decision if it once resulted in a big loss or missing out on a significant gain. Behavioural biases such as these cause an investor to think they have an element of control in areas where actually they have little or none. Passive investors choose to stay invested all of the time, regardless of the market conditions, because they know that short-term volatility is unpredictable. To help them manage their risk, most of them rebalance their portfolios perhaps once or twice a year.
Rebalancing is sort of the antithesis of what the emotional investor would prefer to do. Most emotional investors think there's a trend from the past that will continue in the future. So if you started off with a 50-50 portfolio, and let's say your stocks went up, the active investor often thinks of that as a buying opportunity because something has gone up. But the rebalancer, or the unemotional, disciplined investor, says that that's an opportunity to get their portfolio back in balance, which means you actually sell some of that position that has gone up. And the same is true on the opposite. If your equities have gone down, the emotional active investor often thinks that's a signal they should be selling, but the disciplined, unemotional investor says, I need to buy more of those equities now to get back in balance. And that's actually a much better strategy because you've maintained your risk exposure.
Helping you control your emotions, keeping you invested during periods of market turbulence, and rebalancing your portfolio are all key responsibilities of a financial advisor. Yes, you could try to do it all yourself, but the chances are that if you do, you won't reap the full benefits of a passive, evidence-based approach. So, what are the benefits of emotion-free investing from a performance point of view? Dalbar conducts an annual study called the Quantitative Analysis of Investor Behaviour. Between 1998 and 2017, it calculates that the average equity fund investor who periodically bought and sold earned returns of 5.29%, while a buy and hold investment in the S&P 500 returned 7.2%. An investor who owned a globally diversified index portfolio would have seen returns of 9.04%. If you're still a little sceptical about the wisdom of passive investing, then why not listen to what the most famous active investor of all has to say on the subject? Yes, Warren Buffett is a staunch advocate of index funds. In his 2004 letter to shareholders in his firm, Berkshire Hathaway, Buffett said, "Over the past 35 years, American business has delivered terrific results. It should therefore have been easy for investors to earn juicy returns. All they had to do was piggyback corporate America in a diversified, low-expense way. An index fund they never touched would have done the job. Instead, many investors have had experiences ranging from mediocre to disastrous." In his 2014 letter to shareholders, Buffett said he had directed the trustee of his sizable inheritance to invest 10% in short-term government bonds and the 90% balance in an equity index fund. Not only then does Warren Buffett recommend passive investing for ordinary investors, when he dies, he wants his money to to be invested passively as well. In traditional 12-step programs, the second step is to acknowledge the presence of a higher power. Investors have a higher power. It's evidence. Rigorous, independent, peer-reviewed, time-tested evidence about how markets work and how to invest. That evidence has been compiled over many decades by a distinguished group of academics, many of them Nobel Prize winners. Broadly speaking, their findings can be summarized in three key concepts. The first concept investors need to grasp is the random walk. It dates back to 1900 when the French mathematician Louis Bachelier concluded that there is no useful information contained in historical price movements of securities. Future price movements, said Bachelier, were no more predictable than the steps of a drunkard. But it wasn't until the 1960s that academics acknowledged the significance of Bachelier's contribution, foremost among them the economist Paul Samuelson. His findings can be summarised as follows. Market prices are the best estimates of value. Price changes follow random patterns. And future news, and hence stock prices, are unpredictable. The notion of randomness was further developed in the 1970s by the economist and author Burton Malkiel. In his book, A Random Walk Down Wall Street, Malkiel famously wrote, "A blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by the experts." Both Samuelson and Malkiel had a significant influence on Jack Bogle, the founder of the Vanguard Group, the firm that pioneered passive investing for individual investors.
The random walk hypothesis is really crucial for investors to understand. It in essence says that the current price includes all the information we currently know and actually the impact of that information on the future. So what that really says is now the change in price in the future has to do with new information that is random and unpredictable by definition. Nobody knows tomorrow's news. The recognition of this randomness of returns sort of eliminates the ability for investors to try to pick stocks and to try to time the market. And that's why it's so important that they understand the random walk hypothesis.
The second key concept underpinning passive investing is the efficient market hypothesis. In a paper published in 1965, Professor Eugene Farmer challenged the assumption that the resources available to professional fund managers enable them to outperform a randomly selected portfolio of securities with similar risk levels. His conclusion was that there was no outperformance beyond what you would expect through random chance. In another paper published 5 years later, Farmer concluded that equity markets consistently incorporate all available information into prices, and that trends in capital markets cannot be identified in advance. The only way an investor can expect to beat the market return is by taking risk greater than the market. His work on market efficiency later earned Farmer the Nobel Prize in Economics.
The efficient market hypothesis is one of the most challenged ideas in finance. And finally, in 2013, the Nobel Prize was given for it. Further evidence of its importance is the continued increase in the interest in an index fund. The index fund is actually born out of the idea that markets are efficient.
The third and final concept to consider is modern portfolio theory. It was developed by another Nobel Laureate, Professor Harry Markowitz. He showed that assets should be evaluated not only for their individual characteristics, but also for their combined effect on a portfolio as a whole. Reducing risk, Markowitz argued, was just as important as maximising return, and that requires having a diversified portfolio. Modern portfolio theory has evolved over time. In 1992, for example, Eugene Farmer and Kenneth French expanded on it with a paper on the different risk factors that drive market returns. As much as 96% of historical returns, they found, could be explained by exposure to market, size and value risk. The work of Farmer and French inspired David Booth and Rex Sinkerfield to found Dimensional Fund Advisors, a mutual fund company based in Austin, Texas, that's helping to revolutionize the way we invest.
The Farmer and French multi-factor model was a sort of evolution in the idea of indexing. We started off with just a broad general market based on the market capitalization of companies as sort of a starting point of indexing. Let's just buy the S&P 500 as an example. But as researchers continue to look at different characteristics or dimensions of companies, they realized that small companies, for example, had higher returns than large companies, and value companies had higher returns than growth companies. And so they started moving to the idea that you could construct portfolios, diversified portfolios, with those factors weighted into those particular companies in that particular index, and actually end up with portfolios that are of slight higher returns than the broad market capitalization weighted portfolio.
Of course, it's not essential to understand the finer details of the random walk, the efficient market hypothesis, or modern portfolio theory to be a successful investor. But if you're going to have a passive investment strategy and stick to it, you need to understand why you're doing it. To summarize, markets are broadly efficient. All known information is already incorporated in the price of each security. Markets react to new information, which by its nature is unpredictable. Markets are prone to periods of volatility, but over the long term, they will reward investors for the risk they take. Finally, the most effective way to reduce risk is through diversification. The rational approach then is to invest for a very long time in a highly diversified portfolio and to resist any temptation to change course. We're now going to take a closer look at why it's so hard for the professionals as well as ordinary investors to beat the market by picking stocks. Think about it from a purely logical perspective. Is it realistic to presume that an individual investor or stockbroker can know more than the combined knowledge of millions of traders all over the world?
An investor should think of the market as this huge processing machine, collecting the information and knowledge and forecasts of some 10 million traders on some 44 stock exchanges around the world, trading some 10 billion shares a day. And so what this does is it embeds all of this information into the prices that a willing buyer and a willing seller are willing to trade at. And through this process, we end up with the best estimate of the value of all of these securities, both stocks and bonds, all over the world.
You should think of the market then as a collective brain or a giant supercomputer that works out the very latest best guess estimate of a security's worth based on the combined wisdom of millions of people all around the world. Professor Terence O'Dean studied 10,000 brokerage accounts and discovered that investors habitually overestimated the profit potential of their stock trades. In many cases, their profits didn't even cover their transaction costs. O'Dean also found that many investors are prone to overtrade. In the 5 years to 1996, investors who traded most earned an annualized return of 11.4%, compared to the annualized market return of 17.9%. One of the reasons why investors are so attracted to the idea of picking stocks is that they see so many people who seem to be pretty good at it. Of course, the media loves a good story and is always coming up with examples of so-called star fund managers. But the reality is that fund performance is essentially very random. So random, in fact, that it's almost impossible to distinguish skill from pure luck. Olivier Scaillet and Russell Vermers analysed the performance of 2,076 mutual fund managers between 1975 and 2006. They found that 99.4% of those managers displayed no evidence of genuine stock-picking skill, and that the 0.6% of managers who did outperform the index were statistically indistinguishable from zero. In other words, just lucky. Suppose you are lucky enough to pick a stock that outperforms the market. What then? The evidence shows there's no guarantee that your chosen stock will continue to thrive or even survive in the future. In their 1998 book, Creative Destruction, Richard Foster and Sarah Kaplan showed how the companies that made up the original S&P 500 performed after the creation of the index in 1957. Only 74 companies remained on the list in 1997, and just 12 of them ended up with returns that outperformed the index over the entire period. Searching for excellent companies was like trying to catch light beams, they concluded. They were easy to imagine, but so hard to grasp. In 2010, Mia Statman and Denise Angina wrote a study on Fortune magazine's annual list of America's most admired companies from 1983 to 2007. Using Fortune's ratings, they constructed two portfolios: the admired portfolio containing the stocks with the highest ratings and the spurned portfolio containing the stocks with the lowest ratings. Over that period, the portfolio of spurned stocks produced an annualized return of 16.12%, while the admired stocks produced a return of 13.81%.
I think one of the more common myths is that good companies are actually good investments. And I think if investors were to think about what goes on in a trade, they might realize that may not be the case. So for example, let's say there's this wonderful company that the whole world admires. I don't know, let's call it Apple today. And I want to buy those shares from somebody who's already holding those Apple shares. Well, that individual is going to say, well, wait a minute, I don't want to give up these great expected returns in the future unless you pay me for some of those today. And that's why, in effect, there are no basically free lunches lying around, is the seller demands a fair price given the greatness or the goodness of the company. And when you pay the fair price, you basically earn a return that's appropriate for the risk you've taken. And great companies don't appear very risky to me. Those sort of great, good companies are often fall in the classification of growth companies, and the value companies are typically a distressed company. And when we look at the difference in those returns over very long periods of time, they're roughly 5% per year.
So, do the same rules apply to fixed income or bond investing? Can an active bond manager add value by picking the right securities? Well, someone whose name has become synonymous with bond investing is Bill Gross, formerly of PIMCO. His record is certainly very impressive, but it's also worth noting what Gross himself has to say about it. In his April 2013 investment outlook letter, Gross acknowledged the part that luck had played in his success. All of us, even the old guys like Buffett, Soros, Fuss, have cut our teeth during perhaps the most attractive epoch that an investor could experience, said Gross. In his December 2013 letter, Gross addressed the issue of passive investing. Jack Bogle's early business model at Vanguard promoting index funds was a mystery to me for my beginning years at PIMCO, he said. Why would most investors be content with just average performance, I wondered. The answer is now obvious. An investor should want the highest performance for the least amount of risk. And for almost all measurable asset classes, index funds and many ETFs have done a better job than almost all active managers. It's easy to understand the allure of stock and bond picking, but while it's made a fortune for Wall Street stockbrokers, it's proved far less financially rewarding for their clients. Stock picking is like looking for a needle in a haystack, an ill-fated pursuit that wastes time, energy and money. A better solution is to trust the collective wisdom of the market and to buy the whole haystack. So we've looked at stock picking. Now let's explore time picking, better known as market timing. Market timers claim the ability to predict the future movement of the stock market, getting into the market before it goes up and getting out before it goes down. However, numerous studies from industry and academic experts demonstrate that market timing is a bad idea. In his 1975 study, Likely Gains from Market Timing, Nobel Laureate William Sharpe calculated that a market timer must be accurate 74% of the time in order to outperform a passive portfolio at a comparable level of risk. So what percentage of times do market timing gurus get it right? CXO Advisory Group tracks public forecasts of self-proclaimed market timing gurus and rates how accurate they are. For the period from 2000 to 2012, the researchers found that not one of the gurus was able to meet Sharpe's requirement of 74% accuracy.
In short, the reason that market timers do so badly is that nobody can see the future. I mean, this should be obvious to investors that the future is an unknown. We don't know what's going to happen a month from now, a day from now even. And this random, unpredictable news is what drives prices.
There are two big challenges for market timers: being in the market on the best days and out of it on the worst. The problem is there are very few of either, and both are very hard, if not impossible, to identify in advance. Professor Najat Saihan analysed 7,802 trading days from 1963 to 1993 and concluded that just 90 days generated 95% of all that period's market gains, an average of just 3 days per year. As we've learned, markets are essentially efficient. Prices incorporate all known information. Something that advocates of market timing often fail to grasp is just how quickly new information is devoured by market participants. In his book, Analysis for Financial Management, Robert C. Higgins writes, "The arrival of new information to a competitive market can be likened to the arrival of a lamb chop to a school of flesh-eating piranhas. The instant it hits the water, there is turmoil as the piranhas devour the meat. Very soon, the meat is gone, leaving only the worthless bone behind. No amount of gnawing on the bone will yield any more meat, and no further study of old information will yield any more valuable intelligence."
If you turn on just about any financial news program at any point in the day, it won't be long before you'll hear a broadcaster talk about the future direction of the market, such as the market's going up or the market's going down. And the use of that phrase, going, actually is the reason that investors want to trade. If you hear it's going up, why would you want to buy some of that? And if something's going down, you certainly want to sell it. So why do they do this? Well, in essence, they're encouraging their viewers to call their stockbroker and place trades. And why is that? The advertisers for these financial media programs benefit from trading. It's their business model to make money when people trade. And so when investors can learn that these future trends don't exist, all you can say is the market has gone up or the market has gone down, they will move a lot closer to this idea of being a passive investor.
People invest because they want a return. Buyers pay a price that reflects the risk associated with capturing that return. So a fair price equals a fair expected return. Now, prices may subsequently go up or down depending on new information, but it's best to assume at the time of a trade that the price is a fair one. Time pickers like to think they can predict future market movements, but they can't. Why not? Because they can't predict the next news story. There's no competitive edge that exists other than illegal inside information. The best thing to do is to invest for the long term in a low-cost portfolio of index funds. Seen how picking stocks and trying to time the market is counterproductive, but what about finding a fund manager to do all that for you? Well, it sounds great in principle, but in practice, picking managers doesn't work either.
Trying to pick the manager who will outperform their index in the future is a very difficult task. It goes against the required statement on all mutual fund prospectuses, which is past performance doesn't guarantee future performance. There's a very good reason that the SEC requires that, and there's basically has not been any evidence that a manager's past good results will replicate in the future.
In a study of active fund performance between 2004 and 2017, Morningstar found that an average of only 8.77% of the top 100 fund managers repeated their performance the following year. In 2008 and 2009, none of them repeated their previous year's top 100 performance. Variations in fund manager performance are a function principally of two things. First of all, luck, and secondly, the rotation of the style of their particular fund. When a manager's style is rewarded by the markets, that manager is often credited with skill. But when market conditions change, very often, so too does the fund's performance.
Another problem in the analysis of the returns of mutual fund managers from the past is this unaccounting of the funds that actually went out of business because they had quite horrible returns. We call this a survivorship bias of the data.
Survivorship bias completely skews performance tables. Citing data from the Centre for Research in Security Prices, John Bogle calculated that it inflates the remaining fund's average returns by 21%. A Spiva study found that for the 15-year period to the end of December 2017, only 44% of actively managed funds across all categories survived. Even large institutions and pension plans chase performance, much to their detriment. Many of them hire outside consultants at great expense to choose funds for them. A study by Amit Goyal and Sunil Wahal found that hiring and firing fund managers was a waste of time and money. They analysed the results of hiring 8,755 managers over a 10-year period from 1994. Managers who were hired had outperformed their benchmarks by an average of 2.91% over the 3 years before being hired. But when costs were factored in, those same managers underperformed their benchmarks by 0.47% over the following 3 years. To add insult to injury, the researchers also found that the managers who were fired proceeded to outperform those who were hired. Remember as well that even if a fund does outperform consistently, that doesn't necessarily mean the manager of that fund is genuinely skilled. It can take a track record of many decades to be able to say with any degree of certainty that an outperforming fund hasn't simply been lucky. So, next time you read about a star fund manager, be very cautious. Like unicorns, Bigfoot and the Loch Ness Monster, the idea that you can rely on manager skill for consistent outperformance belongs in the realm of fantasy. When you buy a box of cornflakes, you expect it to contain cornflakes. You know you're not buying granola or oatmeal. It's safe to assume the name on the box is true to the box's contents. This is not the case with active fund managers who engage in style drifting.
Style has to do with really the asset class that the investor tends to tilt their portfolio to. So for example, if you were running a large value mutual fund, you've tilted your stock selection towards value stocks, and that's a style. One of the problems with this is they often compare their returns to a non-value index, such as a large blend index like the S&P 500, and then they claim that they beat that benchmark, when in fact all they did is style drift into value stocks, which we have a long history and documentation that they have had higher returns. So did they actually beat their benchmark, or did they actually take different style risks with your money?
Unlike actively managed funds, index funds are created according to specific criteria, allowing for accurate tracking and prevention of style drift. By definition, they have to stay true to their stated style. According to data from Standard & Poor's Indices versus Active Funds, or SPIVA scorecard, fewer than 40% of active domestic equity funds remained style consistent over the 15-year period ending in December 2017. The bottom line is that if you invest in actively managed funds, then style drift is a very real danger. The way to avoid it? Invest in index funds instead. Most people pay little attention to their cell phone bill. They just look for the final figure at the bottom and write a check. But read it line by line and you'll see that it includes several fees that don't go to your actual carrier. City telecom tax, state telecom tax, and 911 service fee. They may seem small, but over time they add up. Well, just as with your cell phone bill, your investment portfolio is also vulnerable to silent partners.
I like to remind investors that every time they trade, they should think of a long line of individuals just sitting there waiting for this trade to occur so they can all take a little piece of this transaction. You have brokers who get some share of the trading commission. You have mutual fund companies who get a load or a commission every time someone purchases their mutual fund. Then you have these trailing fees. They're called 12B1 fees. And so those are little payments to the broker who recommended the fund. But probably the biggest one are the taxes incurred by active investors when they recognize gains in their portfolio, especially if they're short-term gain. The short-term gain is treated as ordinary income, and the long-term gain is treated as long-term capital gains. But those taxes are really the largest silent partner, and I like to call them a silent partner because so few investors dig into the details of all these costs and expenses associated with their purchase of an investment or a security.
According to a 15-year study conducted by Vanguard founder John Bogle, investors kept 47% of the cumulative return of an average actively managed equity mutual fund, but 87% of the return of a typical index fund. Such contrasts in taxes reveal why passive investing makes for one very sad Uncle Sam. Another problem is that the higher the turnover rate, in other words, the more trading a fund does, the higher the investor's tax liability will be. An average actively managed mutual fund has a far higher turnover rate than a typical index fund. There is, however, an even bigger factor in underperformance by actively managed funds: fund fees.
One of the primary reasons that actively managed mutual funds underperform index funds are the fees. If you were to go to Morningstar today and take an average of all the mutual funds I would say conservatively it's about 1.2% is the average expense ratio of a mutual fund. Now, if we go look at index funds, we can see costs as low as 0.05%. But if you build a global diversified portfolio with a little small and value tilt, you're coming in more around 0.3 or 0.35%. So, that's 1/3 the cost.
Over time, the combined impact of fees and taxes really can eat into an active investor's returns. No investment is free from silent partners, but by keeping their costs to a minimum, passive investors also keep a much higher proportion of their investment returns for themselves. Citizens of Japan speak Japanese, lawyers speak legalese, and leading investment advisors, casino statisticians, and insurance actuaries speak riskies. Riskies is the essential language of investing and is used to discuss topics of risk, return, statistical significance, and time. Risk and returns go hand in hand. You can't expect high returns without taking risk. People are perfectly comfortable talking about the returns portion of the investment process, but they can become very squeamish when they realise they'll lose money on their investments.
The idea of the term riskies came to me as I was sitting in lectures provided by academics who literally speak their own language. And they rattle off terms like correlations and standard deviations and t-statistics that they just assume their audience is aware of and they knew the definitions of. And as I looked around the room, I noticed there were a lot of people who weren't quite following these academics, and it occurred to me they have their own language. We sometimes call it academic speak. But for investors, the important part of that language is this characterization of risk. This relationship between risk and return has to do with the uncertainty of the return and then the price that a willing buyer is willing to pay based on that uncertainty. So let's assume I have an investment that we would expect to earn 10% a year, and you want to buy that from me. One of the first things you want to know is how certain is that 10%. And the more risk or uncertainty associated with that 10%, the lower the price that you would be willing to pay for that investment.
Every investment carries an expected return. The risk of an investment is quantified by the degree to which the returns of the investment deviate from the average return during specific periods of time. Higher risk investments carry a wider range of short-term outcomes, but also carry higher expected returns, compensating investors for withstanding short-term volatility. In contrast, investments that have had a narrow range of outcomes over long periods of time are expected to provide more consistent returns, with the trade-off of lower returns. For example, an all-bond index portfolio has provided a small but consistent return, while an all-equity index portfolio has provided a larger but more erratic return. Higher expected returns are the reward for an investor's willingness to accept this volatility. In other words, risk is the source of returns and should therefore be embraced in appropriate doses.
A measure of the volatility of investment returns that's most often used is standard deviation. It's a standardized measure of how much returns deviate from the average return. If we were to look at the S&P 500 over the last 87 years, we would see that the average is about 10%, but about 2/3 of the time, we see a range of 20 on the plus side and 20 on the negative side. So we like to say that the S&P has an average of 10 and a standard deviation of 20.
The concept of standard deviation is illustrated in this bell-shaped curve. The curve represents a set of outcomes. In this case, let's say the outcomes are the monthly returns of an investment. The yellow area covers one standard deviation either side of the average and accounts for approximately 68% of investment outcomes in a given period. The area within two standard deviations of the average, shaded yellow or green, accounts for 95.6% of outcomes. And the area up to 3 standard deviations away from the mean, shaded yellow, green and orange, accounts for 99.7% of all outcomes. The higher an investment's standard deviation, the greater the chance that future returns will lie farther away from the average return.
What we have here is a probability machine. The probability machine helps demonstrate randomness, sometimes called chaos up top as the beads bounce around like crazy, and the normal distribution of stock market returns. The reason that we have this machine is to use this as a tool to explain stock market randomness. So as you look in the background here, you see these red bars. Those red bars represent 600 monthly returns of a globally diversified portfolio of index funds of stocks. Okay, this is equity portfolio, right? And what you see is right down the middle is about 1% a month, and in the extreme tails are plus 15% in a month and minus 15% in a month. And about 2/3 of the time, it's plus or minus 4.5%. That's called the standard deviation.
It's also useful for investors to think in terms of the different dimensions of risk that drive investment returns. We owe our understanding of these risk dimensions principally to two academics, Eugene Farmer and Kenneth French.
The multi-factor model took the equity returns of stocks and carved them up into slices, basically looking at the size of the companies and a value growth metric. And so by dividing up the market into these slices and looking at the returns of these different slices, academics, and primarily Farmer and French, uncovered that there had been higher returns among small companies and among value companies. And then when you blended that, you even had a combination of these factors for even higher returns.
Just as there are risk dimensions with stocks, there are also different factors that drive bond returns. The term or maturity risk factor refers to the difference in returns between long-term government bonds and short-term treasury bills. Longer-term bonds are riskier than shorter-term instruments and have historically yielded higher returns. There's also the default risk factor, which is associated with the credit quality of bonds. Instruments of lower credit quality are riskier than those of higher credit quality, again yielding higher expected returns. Risk, you'll have noticed, is a very complex subject, and you don't need to be an expert to be a successful investor. However, you do need to understand the basic principles. In a nutshell, returns are the rewards for the risk an investor takes. So as well as exposing your portfolio to general market risk, it also makes sense to utilize the different dimensions of risk to maximize your returns. We think of the financial markets as very much part of the modern world, but they've been around for much longer than you might think. Investors have reams of historical data at their disposal, yet they tend to base their decisions on very recent data and assume that a fund that has performed well over, say, the last 3 years will continue to perform well in the future.
The first problem investors have is collecting a large enough sample size so that they can characterize the risk and return of an investment. Now, how large of sample you need is tied to how variable the data is, okay? And we have stock market returns with 20% standard deviations. That's very large from a statistical point of view. So preferably, we'd like to see at least 30 years, but my preference is even 50 years, and most academics want to see the whole 87 years of data before they would start making generalizations or estimations about the expected returns or even the volatility of stock market returns.
In the 5-year period from 2013 to 2017, the S&P 500 index had an annualized return of 15.79%. Based on that return, many investors would conclude that the S&P 500 was a shoot-out-the-lights investment. However, for the 20-year period ending 2017, the annualized return was much lower at 7.20%. For the 50-year period ending 2017, it returned 10.12%. There are times when investing is like riding a roller coaster. History is littered with examples of market crashes, the biggest of which came in 1929. Now, this is the ticker tape from the day of the stock market crash in November 1929. And in those days, trading volumes were so low that you'd get about 3 or 4 listings every hour. But this represents the first 45 minutes of trading on that day. Later that day, a broker from Boston fished this ticker tape from out of the trash because he realised that this was a very significant day in history. He framed it and he put it on the wall of his brokers in Boston just to remind himself and his colleagues that crashes like this, really severe crashes, do happen. But despite such crashes, the financial markets have almost always rewarded patient investors. The most complete historical database for stocks, bonds and mutual funds can be found at the Centre for Research in Security Prices, or CRISP, based at the Booth School of Business at the University of Chicago. It provides data from 1928 to the present day. This graph shows the growth of a dollar in various indexes over the course of 90 years. During that period, there have been some very major news events. While it's true that those events did have big, short-term impacts on market prices, they proved to be largely inconsequential in the long term as the market marched ahead. Despite several setbacks, capitalism has not only persevered, but thrived.
Depending on where you start a monthly return series, you can get very different results. If I look at results from January to December, I can see one kind of return, but if I shift that even 1 month, you can get a very different return. When you look at data on a monthly rolling basis, you're in essence capturing a simulated passive investor experience.
The information contained in monthly rolling data is far more detailed than yearly data. For example, in a 50-year period, there are 589 rolling 12-month periods as opposed to 50 consecutive non-overlapping 12-month periods. This table charts the comparative performance of different equity indexes from 1928 through 2017. It shows that over 1,069 one-year monthly rolling periods, a simulated passive investor in a large growth index beat a simulated passive investor in a large value index 45% of the time, causing investors to think it might be a toss-up between large growth and large value. But in 841 20-year monthly rolling periods, the large value index beat the large growth index 89% of the time. Over short periods, volatility and price swings confuse investors as to which indexes are better long-term investments. But the picture becomes clearer when longer periods are considered. So, studying market history helps investors to understand the risks and returns associated with different asset classes. It helps them to build an asset allocation appropriate to their risk profile. It also equips them with the knowledge needed to withstand short-term market volatility. Picture the market as a wild bull, bucking up and down, rearing, kicking and twisting. Investors are like bull riders, and matching the right portfolio to an individual's ability to handle risk is like finding the right bull for each investor to ride through the ups and downs of the market. Each investor has a unique risk capacity, which can be quantified in what's called a risk capacity score. Higher scores signify a higher capacity for risk, a longer time horizon, and an ability to withstand market volatility. Investors with higher scores are generally recommended to hold portfolios with a larger allocation of stocks. By contrast, lower scores signify a lower risk capacity and a greater need for liquidity. Investors with lower scores are steered towards more conservative portfolios that hold a higher proportion of short-term bonds. Risk capacity can be regarded as a measurement of an investor's ability to earn stock market returns. Calculating risk capacity is the first step to deciding which portfolio will deliver optimal returns for each investor.
Where many of these surveys focus on just your feelings about a loss, that's where they call it the risk tolerance survey. I see that as really just one dimension of my 5 dimensions.
The 5 specific dimensions of risk capacity are these: time horizon and liquidity needs, attitude toward risk, net worth, income and savings rate, and investment knowledge. It's hard to overestimate the importance of calculating an accurate risk capacity score. You, as the investor, need to take an active role in helping your advisor to work it out. Get it right, and you're far more likely to enjoy a successful investment experience. Once your capacity for risk has been evaluated, the next step is for your advisor to construct a suitable investment portfolio. There's one man more than any other who's contributed to our understanding of portfolio construction, Professor Harry Markowitz. As a PhD candidate in the 1950s, Markowitz believed that investment professionals erred by focusing too much on the returns of individual stocks with no consideration for the concept of risk exposure. Markowitz set out to prove that you could generate bigger investment returns by optimizing the trade-off between risk and return. In his Nobel Prize-winning paper, Portfolio Selection, Markowitz established the importance of diversification. He asserted the best portfolios include non-correlated stocks that act and move independently from each other. Today, trillions of dollars worldwide are invested according to his principles of risk and return.
The risk exposure that an investor has in their portfolio can really be best characterized, first and foremost, by their allocation between stocks and bonds. But beyond that, we want to build exposures to risk factors that we know have correlation to returns over the very long term. So we would start with a global equity portfolio, but then tilt that portfolio to value and small companies around the world in emerging markets and international markets and US markets. And so you can blend these various asset classes together, really indexes from all over the world, in a way that you maximize the return given a certain level of risk.
Investors should think of their portfolios as an investment in global capitalism. With a total market cap of over $51 trillion, annual profits of over $2 trillion, more than 13,000 CEOs worldwide, and more than 82 million employees selling products in 195 countries, it simply isn't reasonable to believe that Capitalism Inc. will go out of business. And if it did, your money would be worthless.
Portfolios should include a broad, diversified exposure to equities within each geographic area of the world. Now, it's also good to have some exposure to real estate. It's a little bit unique of an asset class, and it has a low correlation of their returns with equities, meaning if equity markets are up, you might see real estate down, and when equity markets are down, you could see real estate up. And then lastly, you should have a broad diversified exposure to fixed income. The fixed income should include some governments and some corporates and some maturities that pretty much stop at 5-year maturities. If you go much longer than 5-year maturities, investors subject their portfolio to greater risks, but not much greater returns.
Once investors identify the asset allocation that matches their risk capacity, they have a choice to make as to how best to implement that asset allocation. A small number of fund providers offer asset class indexes, the most prominent of which are Vanguard and Dimensional Fund Advisors.
The differences between Vanguard and DFA first have to do with the definition of their indexes. So if we were to see the rules that they use to construct small and value, for example, you would see they actually use different criteria to define what's small and define what's value. And finally, when they go to implement or actually purchase the stocks to complete the portfolio, they also have different rules as to how they implement the actual portfolio. And so when you combine all these factors, you end up with very different returns for investments that have the same name and even different fee levels. The Vanguard is actually a lower fee, and the Dimensional is a little higher fee, but the Vanguard actually had a lower return among many of the asset classes that we show.
This chart plots the risk and reward for 20 index portfolios and for various indexes over the 50-year period from 1968. In a nutshell, it shows the benefits of efficient portfolio design. The number of each portfolio represents the proportion of stocks. So portfolio 70, for example, contains 70% stocks. Note how the S&P 500 index had similar risk characteristics to portfolio 90, but delivered a lower return. The chart clearly shows the value of diversifying beyond large-cap companies in the US, as reflected in the S&P 500 index. Portfolios 65 to 90 all delivered higher annualized returns with similar or less risk than the S&P 500. Our journey of discovery is almost at an end. We have just one more issue to explore, one more lesson to learn. A lesson that might well make the difference between your achieving your investment goals and not. So we've learnt how to invest. Not to speculate as most people do, but truly invest. How to calculate your capacity for risk and then to build a portfolio that maximizes the returns you can expect for the level of risk you decide to take. Armed with that information, you could probably manage on your own without a financial advisor. But there are some very compelling reasons why you shouldn't try to.
We actually went back and looked at over 650 clients who invested with us over a 7-year time period from before the 2008 crash up till 2014. And we were quite surprised to see when we divided those clients into a couple buckets, those who basically followed our advice and those who didn't follow our advice but actually stayed here at the firm so we could actually track how well they did. What we discovered is those clients who basically stuck with the program, the passive investing program, they are actually earned the full return of the original index portfolio they were advised to invest in. But then the group who decided to kind of go on their own, sort of the rogue client, if you will, and were concerned about the market, so they went to cash. Then they decided when was the right time to come in, and they basically decided they wanted to take over their portfolio. We put them in another bucket, and what we found is they only earned 70% of the return of the original portfolio they had elected to be in. So that was a 30% cost to them by not sticking with the advice of an advisor.
Look, for example, at the financial crisis of 2008. Confidence was high the previous October when the Dow Jones Industrial Average reached its peak of 14,164. The Dow then steadily declined for more than a year and then dropped sharply by 22% in just 8 trading days in October 2008. The market continued its decline over the next 5 months and bottomed out at 6,547 in March 2009. Many investors pulled out of the market altogether, but the Dow then shot back up, hitting the 17,000 mark in July 2014. Those who threw in the towel caused irrevocable damage to their long-term returns. The legendary investor Benjamin Graham once said, "The investor's chief problem, even his worst enemy, is likely to be himself." And indeed, some investors get in the way of their own success. You may want to see the fees you pay to a passive advisor as an insurance premium, insuring against your mistakes and lack of knowledge. So, how do you find a suitable advisor?
Through my experience in talking to many investors over the 16 years that I've been doing this, one of the most misunderstood concepts is this idea of a fiduciary. A fiduciary is somebody who has an obligation and a duty to do what's in the best interest of the other party, even if it goes against their interest. And what's so surprising to so many investors is that a broker working at a brokerage firm actually has an exclusion for being a fiduciary to their clients. I always like to tell people, follow the money. And so if you follow the money for the broker or an advisor who isn't a fiduciary, you'll see that they get their compensation, their payment, for the products they sell or for the activity that they generate from the client. But someone who has a pure fiduciary duty is paid directly by the client, which aligns their interest with the interests of the client.
In short, you need to find a financial advisor who is unconflicted, who doesn't receive commission for recommending certain products. You want someone who will recommend a course of action for one reason and one reason only. It's in your best interests. Remember, you're also looking for an RIA with an evidence-based investment philosophy who specialises in passive investments. He or she should be able to help you invest according to your risk capacity, properly allocate assets across a blend of globally diversified, passively managed index funds, maintain a portfolio with appropriate risk exposure, avoid the impulse to react to market volatility, and minimise investment costs and taxes. We've looked at the importance of asset allocation and matching your portfolio with your capacity for risk from the outset. It's also essential that you maintain the appropriate asset allocation throughout your investing life. This is achieved through rebalancing, which is something else your advisor can do for you.
Because investors are compensated for the risk they take, they need to make sure that they hold that risk constant over time. One of the primary strategies in doing that is a rebalancing of the portfolio. This is a difficult move for investors. It's actually counterintuitive to what you might emotionally want to do. If the markets have gone up 10%, your intuition might say, gosh, it's going to continue to go up. I don't want to sell now. I want to wait until it's going down, okay? But nobody knows what these directions are in the future. And so to be disciplined about this, you want to set boundaries, and when you reach those boundaries, you automatically adjust your portfolio and maintain the risk exposure that's appropriate to your risk capacity.
Your advisor will also need to devise what's called a glide path strategy for you, reducing the level of risk you take the closer you come to retirement, by increasing the proportion of bonds in your portfolio and reducing the number of stocks.
Another very important role for advisors is to monitor the tax loss harvesting opportunities for investors in taxable accounts. So what is that? I like to call it the silver lining in the cloudy, bad market, the scary market that's kind of like a dark clouds in the sky. But the silver lining around those clouds is the opportunity to actually harvest those losses, which basically give you credits against capital gains tax that you may have to pay in the future as you recognize capital gains. And so the way we do that is we monitor investments for losses of 10% and $5,000. And once we reach that trigger, we alert the client that it would be time to harvest that loss, which is basically sell the index that's down, buy another index that's in a different asset class for 31 days, and then 31 days later you reverse that back to the original position. It's a complicated strategy, but it can be very beneficial to clients in taxable accounts.
And that brings us to the end of the 12-step recovery program for active investors. We've come a long way. We've seen the detrimental impact our own emotions can wreak on our investments. We've taken a brief walk through the milestones of financial science and learnt to respect the collective wisdom of the markets. We've observed the futility of chasing performance. We've seen the self-defeating nature of trying to predict future market movements and the huge part played by random chance in fund returns. We've learnt how risk and return go hand in hand. we've seen how markets have continued their long-term upward trajectory, despite numerous events that at the time seemed catastrophic. We've learnt how important it is to evaluate your capacity for risk and to build your investment portfolio accordingly. And finally, we've seen how having a trusted passive advisor can help you feel relaxed about your investments.
I wanted the investor to be able to invest and relax, and to have a peaceful and profitable investment experience, so that in their retirement years they can actually enjoy themselves and not be nervous or fearful that someday they're going to run out of money or have to rely on the government or family to support them.